Hey, Professor, I had a question. Can you hear me?
I can.
Okay. I was wondering, I have in my planner research report milestone covering modules 5 through 8, 10 points. What is that?
Um, Trying to log into our site here. If I heard your question correctly, you had in your planner the milestones for modules 5 through 8. Is that correct?
Yeah.
So the milestones are meant to keep you on track with regard to the semester research project. So you'll recall that if you look at the examples posted to Canvas, in the back, there's an appendix, and the appendix covers modules 1 through 15. So when you get to module 5 or module 8, you should have some language in that appendix that covers everything in that module. And some of it will be relevant to your company and some of it won't. Tonight I'm talking about intercorporate investments, and not all businesses have intercorporate investments. So if yours does not, then that's going to be a pretty easy module for you. And as a milestone, you would just go back to the report and simply note that you don't have any intercorporate investments, and you can check the box, so to speak.
Oh, gotcha. Cool. Thank you.
Yeah. So, okay. Well, I do have a pretty good sized lecture tonight. Thank you for accommodating my schedule last week. I had an unforeseen conflict and needed to cancel class, but that's one of the pros of having a virtual setting like this. We do have a little bit of flexibility, and I have all these lectures recorded on our YouTube channel, so it's pretty easy to skip a night or to swap a night. So tonight I'm going to lecture over module 9, which I had planned to lecture over last Tuesday night. I do have a pretty good lecture out there on our YouTube channel for module 10, so I think it would benefit the class the most if I did lecture over module 9. It's some of the more technical material in the class, so I want to get through it tonight. Let me pause to take questions at the top of the class and address a few things. The second exam should be wrapping up. I think it closes tonight at midnight. And after the exam closes, remember, you'll be able to go out there and get feedback. Immediately after you take the exam, you can see your score, but not until the exam actually closes can you go out there and get feedback. And that's for a reason. I don't want anybody that hasn't taken the exam yet to have an advantage if they were to, I don't know, if somebody were to share some of that feedback with them. So that usually addresses, in my experience, that addresses 99% of all the questions I get in class. So hold your questions until that feedback period is open. Check that first, and then loop back to me if you feel like there was any questions on that exam that were confusing or not phrased fairly, and I'll award you the credit. I have had a couple students reach out to me with a little bit of concern about their scores on the exam, and I will remind you that scores on the exam are typically lower than most of the classes you'll take at UMKC, and that's just the way this class works. The average or the median score on those exams is in the low 80s, and I structure the course so that there's plenty of points outside of the exams that you're going to be able to go after to get your scores up for the semester. I think there's 700 points in 1,000-point course outside of the exams. So got 300 points in that research project, got 50 points in the presentation, got several hundred points worth of homework. Just get all those points. If you were a little bit disappointed with your exam scores, those are participation points, for lack of a better descriptive term. If you go do it, you're gonna get the points, and you have as many chances as you want at that homework. And if you're struggling with one of the homework problems, just let me know, and I'll make sure to get you the credit on the homework, just like we do the exams, if there's something that is just not tying out for you. So Okay, that's my setup for tonight's class. What questions, concerns, anything of topic that we want to discuss before I dive into a lecture on Module 9? Mhm. Okay, let's see. How do I, there we go. I want to share my screen and go over here to Module 9. Let me see if I can blow this up for you guys. Okay. Can you see that? Module 9? Everybody looking at Module 9? Can I get a
Yes.
Okay, thank you. I don't know who that was, but thank you. I was talking to my business partner on the way out of the office today, and we were just kind of shooting the breeze, and I told him I was teaching tonight, and I commented on just how I used to love being in class because we could have real interaction, and I don't blame you. This is exactly what I do. You get to these virtual settings, and you kind of turn your camera off, and I was trying to sit through a virtual webinar yesterday, doing the same thing. Had my camera off. I was eating my lunch, trying to answer some emails and take care of this or that at the same time. But it just kind of feels like sometimes I'm talking into a black hole. So I sure do appreciate it when somebody chimes in with a yes. So thank you. Okay, let's do Module 9, intercorporate investments. Now this will apply to most of you. Most of you are looking at Fortune 500 companies, and most Fortune 500 companies have made investments in other subsidiaries or in other companies, or maybe joint ventures or partnerships. That's very, very common. And tonight we're going to look at how we account for those types of entities. And there's a variety of different accounting treatment. So, and the first one that we're going to look at are marketable securities. And you can think of marketable securities, by and large, as those that trade on a public exchange. Most will, some don't. We're going to look at the accounting for both types. Oh, crud. Hold on. Okay. I'm just going to go from this view because I don't like it when they bring in each bullet point at the same time. And I figured out how to turn that off last week, and I don't want to take time out of class to refresh my memory. So moving on, let's talk about intercorporate equity investments, where one company purchases the voting stock of another. Again, publicly traded is what we're talking about right now. And you can do that for a variety of reasons. Maybe you just want to put money to work because you have excess cash. Maybe you want to form a strategic alliance with another business, so you start buying some of their stock. Fourth option might be targeted projects or a joint venture, market penetration or expansion. Lots of reasons why a company might buy the stock of another, sometimes even competitor. And this will all typically be disclosed in a press release, and you can go find out what the rationale for something like this is by reading analyst reports and other industry reports. And that's your job as a research analyst, to make sure you understand those strategic investments as they exist and as they are disclosed inside of your company's 10K filing. And that's going to tell you a lot about the industry. It's going to tell you a lot about the company strategy. You're going to get insightful commentary from management, sometimes even more poignant, more meaningful than just about anything else that you'll get, because oftentimes this is where they're investing the majority of their cash flow. And research and development opportunities, or mergers and acquisition opportunities, that's an exciting career track. I've done it myself. I've worked with a lot of people in M&A, and it's a fun hiring spot, after your time here at UMKC. So we differentiate between whether or not a company has control or no control, and that's going to dictate the accounting. If there's control, then it's pretty simple. We're going to consolidate both entities, and I'll show you how we do that. If there's no control, then you're looking at influence. If they have little or no influence, meaning, you know, maybe they own a few shares, but it's not significant, then we're going to use the fair value method. Fair value method's pretty easy. We just look at what the price the stock's trading at and adjust the value of that on our balance sheet quarter to quarter to quarter. And any increase or any decrease results in an unrecognized gain that we book on our income statement. Now, what if we don't have control, but we do have a significant influence? Then we're going to use an accounting method called the equity method, and I'll show you how that works. We don't mark. It's called mark to market when you adjust to the value of the stock that you own on a quarterly basis. That's called mark to market. With the equity method, we don't mark to market. We don't change the value of the investment on our books, but we do treat it as if we are a material owner and book the dividends and earnings from the company on our balance sheet. I'll show you how we do that too. So, okay, let me hit the main points here. Here's one. The thresholds are something that you need to know. Be aware of the thresholds. The thresholds for significant influence are 20 to 50%, but it's not that hard and fast. Sometimes you can have a smaller ownership, but significant influence if you have legal agreements or licenses or the other rights to use technology. This will all be disclosed in the 10K filing. So just kind of be aware of something like that. Okay, let's look at the, we're going to take a deeper dive into each one of these, but this is a great table, so you might just star that. It gives you the accounting treatment for each type of situation that we just looked at: fair value method, equity method, consolidation, what happens on the balance sheet, what happens on the income statement, and what happens on the cash flow statement. So just, again, great table to star and be familiar with. We're going to go through an example of each one of these. Okay, I made the distinction a moment ago between marketable and non-marketable. Marketable is easy. If they're marketable, then you're typically going to get a publicly quoted price, you know, like a Microsoft or a Google or an Apple or, you know, any of the big companies. Any company that we're looking at in this class this semester is going to be a marketable security. And it's going to be a pretty easy thing to know what the value of that security is. If it's non-marketable, meaning non-publicly traded, a little bit harder to sell, maybe you don't have a quote, maybe you don't have a price, the accounting treatment's still the same, but now you have a problem on your hands. When you need to know the value and you don't have a marketable quote, well, what means are available to you as an analyst to go out and get that value? Well, certainly all of the means are available to you as an analyst that we're reviewing in this class this semester, some of which might be peer group analysis, comparable company analysis, discounted cash flows, ratio analysis, so on and so forth. We're going to take a deeper dive into all those valuation techniques in modules 11 through 15. So 2 weeks from now, we'll be wrapping up the heavy accounting treatment of this course and moving into the valuation section. So all of those techniques could be used to put a value on a non-marketable security. Okay, so for either one of these, when we have the acquisition or the sale, we're going to use the purchase price, and that's what's going to show up on the balance sheet, and that's called book value. Now, when the investment is sold, we're going to take the difference between the sales price and the book value and recognize a gain or loss on our balance sheet. So you have gain or loss on sale equals the proceeds from the sale less the book value of the investment sold. That part's pretty easy. The treatment with regard to how we recognize any fluctuations in the value between the time we buy it and sell it differs a little bit. Let's take a look at an example of a passive investment. In this instance, we're looking at Alphabet. So let's assume Alphabet purchases 1,000 shares of Juniper Networks for 20 bucks in cash. And then they subsequently sell 400 of those for $23 in cash. So they just booked a gain right there, $3 per share times 400. So they're going to book a $1,200 gain, which shows up right here. But firstly, on the purchase, you have $20,000 worth of cash going out the door. That's the debit. You have the credit to marketable securities. That's the easy one. When they sell 400 shares, you have $9,200 worth of cash. That's the debit. You have 8,000 marketable securities. That's the credit. And then to make the whole entry balance, you're going to debit a gain on sale of $1,200. Okay. This, what we just looked at here, is called fair value method accounting for equity securities. And there are three different, this is terminology that you need to be aware of. Level 1, level 2, level 3. Sometimes you'll see these levels as referred to with like publicly traded market prices. So level 1 is a quoted market price. Those would be like for your equity securities. Level 2 would be quoted market prices for similar securities. So you don't have a good price on the company that you're looking at, but you have a good quoted price on a very similar company, and you can use model-based valuation techniques. And then lastly, these are the most illiquid types of securities. You have very little to go on, unobservable inputs, which might require you to do a discounted cash flow model or something like that. Okay, let's look at another example here. This is a fair value adjustment. What happens when that Juniper Networks stock that we just bought increases in value before we sell it? So in this instance, we had bought it for 20, you'll recall, and it jumps to $25 a share. But we're not selling it yet. We want to reflect that on our balance sheet when we get to the end of the year, because we know that, well, we have 1,000 shares of stock and it just increased by 500, or I guess we now have 600 shares of stock, excuse me, because we sold 400. At any rate, the gain on that is $3,000. It's unrealized because we haven't sold it yet. So here's our journal entry. We're going to debit marketable securities for $3,000, and we're going to credit an unrealized gain for $3,000. You can see the unrealized gain shows up on the income statement, and that flows through to the balance of non-assets on the balance sheet. So this can result in some pretty wild swings in the value of your assets on your balance sheet, and we're running these unrealized gains through the net income component of our income statement. So think about what's going on here. If you all the way back to module 1, how do your management teams get paid? If we're going to book these unrealized gains and unrealized losses through the income statement, this could affect comp. This could affect all your ratios. This could affect your peer group analysis. You really need to be aware of what's going on here, especially if your company has a material position in any of these securities. Okay, our authors give us an example of how these are disclosed. I won't dwell on that. Slide number 13 basically talks about the different techniques we might use to value level 3 types of securities. And again, we're going to get deeper into each of these techniques in the coming weeks. Okay, So, word to the wise analyst here, FASB is always making our lives interesting or complicated or keeping us employed, as the case may be. These rules changed in 2018. So if you're looking at any financials that go back prior to 2018, you may not have an apples to apples comparison. So you need to be aware that prior to 2018, unrealized gains and losses were omitted from both the balance sheet and the income statement. We didn't used to mark-to-market securities like this. And so we made a change in the accounting. Now we do. You may not have apples to apples comparison. Just be aware of that when you're looking back. And our authors give us an example here of other income that showed up on Alphabet's financials going back that far. Okay, all of the examples that we've looked at so far have been equities primarily. We can also do this with debt. Debt's a little trickier. You don't always have a good quote like you do equities. They come in 3 different flavors. There's 3 different accounting treatments for types of debt. And you need to recognize that we have debt securities that we intend to hold to maturity. We have debt securities that we classify as available for sale, and we have debt securities that we classify as trading. Who determines whether or not a debt security is held to maturity, available for sale, or trading? Well, the management team does. And I've already mentioned that there are different accounting treatments for each classification. So that introduces some measure of subjectivity into this analysis, and your ears should be perking up, or the red flag should be going up, or some alarm bell should be going off here, because anytime you hear that term subjectivity, or anytime you hear that term estimate, or anytime you hear any margin for that management team to get involved at all, you know that there's some opportunity for gamesmanship. And that's exactly what we have here. So we need to be aware of the accounting treatment for each of these and how they could potentially be manipulated a little bit. Let's start with held to maturity debt securities. Changes in fair value do not affect either the balance sheet or the income statement when a maturity is classified as when a fixed income investment is classified as held to maturity, excuse me. All those fluctuations in fair value from quarter to quarter are just going to be ignored. Now, when we have an available for sale security, all those fluctuations in fair value are going to be recorded very similarly to the way that we just recorded changes in fair value for equities, only we're not going to book an unrecognized gain or loss. We are going to book an accumulated other comprehensive income, which is not the first time we've mentioned this in this term in this class, but tonight we're going to cover 3 distinct accounting subjects where the accumulated other comprehensive income line is affected. So we need to go a little bit deeper into what the heck is accumulated other comprehensive income. You get to the bottom of the income statement and you see net income. Well, that's supposed to be the bottom line. Well, it's not really the bottom line because there's something underneath net income. You can dig a little deeper for something called accumulated other comprehensive income. And FASB tells us that accumulated other comprehensive income is meant to house those income items that are somehow unusual in nature, infrequent or unusual in nature. And what we have here with available for sale securities, these fluctuations in the value of these investments can be, well, they can be very large, and FASB wants them to flow through the income statement upon the actual sale, but they don't want them to influence the income statement beforehand. So we put them in a category called accumulated other comprehensive income. But now that you know what that is, and now that you know that there's a statement called accumulated other comprehensive income, and now that you're a savvy analyst because you've taken this course, well, you're just going to look at that statement and I don't know what difference it makes anyway. But this is the accounting treatment for it. So let's look at how that would be reported. And here are the disclosures for Alphabet's debt securities. So we have the adjusted cost, unrealized gains, unrealized losses, fair value, cash, marketable securities, non-marketable securities. Look for this disclosure in your 10K filing. Be familiar with what that is. When I forget who asked a question about the module 9 milestone, or maybe it was the module 8 milestone. This is the type of table you would cut and paste out of your 10K filing, just to show that you were current, relevant, had covered that topic in the review of the module material. And as long as you could show that you had covered the material and come to the conclusion that it was insignificant, then you're going to be just fine when it comes to grading your research report. Okay, the realized gains from any securities that we have in the available for sale category, any valuation changes from securities that we have in the available for sale category, those all get reclassified to realized gains upon sale. And you can see how that's reported here on Alphabet's income statement, where we're going to subtract a reclassification adjustment for net gains and losses included in income. Here's another disclosure statement, rather this is the balance sheet. So take a look at that. That's pretty self-explanatory. And then we'll move on to the equity method of investments. So we just covered, fair value primarily for equities and fixed income. Equities were a little easier. Fixed income had the distinction of accumulated other comprehensive income or net income. Equity investments are going to be just slightly different. When we look at equity investments, we're going to identify that term that we talked about at the top of class, significant influence. That's what we're looking for, which is typically 20 to 50% ownership, but can be less, remember, depending on certain factors. But for the purposes of our conversation, let's just stick with 20 to 50, less than 50, so we don't use the consolidated accounting for sure. Now, when we have 20 to 50, we are going to firstly record the purchase at the purchase cost. That's the easiest number to identify typically. We know what we paid for something. We always know what we initially pay. How the fair value fluctuates after that, how we account for dividends, how we account for other expenses, how we account for other revenues. That's where it starts to get a little tricky. So the investment account, meaning this is the investment account, what we originally pay, puts the investment on our books at book value. Now that account is going to be adjusted or increased by the percentage share of the investee's income, or decreased by the percentage share of any loss. This is the most important bullet point on the page. If you want to just circle that or star that, remember to come back to it, because you need to know that with the equity method of accounting, if a company issues a dividend, we are going to reduce the investment account on our books. Now, why would we do that? If we get a dividend in the check in the mail, that's a good thing, right? We're going to get cash. Well, when we use the equity method, we're recording that investment as if we were an owner, and we want to show that investment on our books as if we own a piece of that business. So when that business sends cash out the door, our investment in that business is now just slightly less than what it was before. Sure, we're going to get a dividend check. We're going to cash that dividend check. We're going to increase the cash on our books, but we're simultaneously going to decrease the investment account that reflects what that investment is worth on our books. So net, it's a push, but it's a more accurate representation of our interest in the business. Let's look at an example. So Google, in this case, has a 30% interest in Mattel Networks. Mattel's balance sheet reports $1,000 of stockholders' equity. Mattel reports profits of $100 and pays a $20 cash dividend. So time period 1, we got $300 in cash going out the door, and that gets us a $300 investment in Mattel. That's the easy one. Time period 2, Mattel reports $100 in income. Now remember, we own a 30% stake. That's where this $30 number comes from. So we're going to increase our investment in Mattel by $30. So that investment, Mattel just earned money. That's net income. So we're going to raise our investment in Mattel. That flows through to equity income and ultimately retained earnings. Now the reverse of that is in time period 3 here, when Mattel pays a dividend. We get the cash, but we simultaneously lower our investment in Mattel. And just like I said a minute ago, that results in a push. It's basically a non-event for us because we get the cash, but the book value of our investment simultaneously declines, so our balance sheet doesn't move at all. But we are utilizing a different accounting treatment to record the value of that investment. And you can see here the income statement for Mattel. We had 300 in sales, 200 in expenses, and $100 net profit. That $100 net profit flowed through to Google's income statement at the percentage owned, and the equity income of Mattel increased by 30. This would show up on the income statement. And then the investment in Mattel is adjusted by the same number. And we show a 30% interest in the book value of Mattel on our balance sheet. And that's called the equity method of accounting. Okay, let's talk about what happens when we're buying a business for more than book value. So if we buy a business, typically we recognize all of the value associated with every asset that business has. And if we buy a business for book value, then there's going to be no difference between the value of the assets and the value that we paid for the business. But if we buy a business for more than book value, we're going to recognize some gap, meaning all the assets are going to be acquired and they're all going to be required at fair value, but we just paid more in cash than those assets are worth. Now, why would we do that? Well, we do that because there's some value associated in that business that's over and above its assets. And this happens all the time. And these are unrecognized assets, could be copyrights, could be trademarks, could be clientele base, could be lots of different things. And we want to make sure that in any M&A transaction, we identify what those are so that we can discreetly add them to our balance sheet and amortize them over time if necessary. To the extent that we can't identify any intangible assets, but we've still paid more than book value, as a last resort, we will book goodwill. Okay. I'm going to fast forward through that slide there. I think I covered all these points too. Okay. Here's where it gets tricky. And this is where you as the analyst really earn your stripes, so to speak, is when we recognize what happens when gross assets and liabilities are left off the investor's balance sheet. Because we're using this accounting to book an investment as an investment itself. But really, we have rights to a certain percentage of another business's revenues. We have rights to a certain percentage of another business's expenses. And the net between those revenues and those expenses creates an income. But we're ignoring everything except for that income number. And then we take a little piece of that income and we stick it on our balance sheet. Well, when we do that, we can distort the accounting a little bit. And if you look at the effects on ROE, you just kind of need to notice that most analysts are going to include equity income in operating profit because it relates to operating investments. That's fine. However, the sales of the business are not included in net operating profit margin. And therefore, you're going to get a net operating profit margin that is overstated just a little bit. If this is material, if you have a lot of investments that are using the equity method of accounting, you're not going to be able to compare your net operating profit margin to that of your peers on an apples to apples basis, and you're going to have to make some retroactive adjustment to the accounting and to the ratios. This doesn't happen very often, but you do need to be aware of it. Same way with net operating asset turnover. We've already kind of touched on this. Happens with every accounting metric that we're going to look at throughout the whole semester. If it's material, meaning I usually define materiality as anything over a couple percent, but certainly by the time you get to be 5% of a company's balance sheet, you're going to have a material impact on all of the ratios. So if any accounting treatment that we're looking at throughout the entire semester is material, it's going to affect your ratios, and your ratios aren't going to be comparable. So you're going to have to go back one by one and restate those ratios. So net operating asset turnover is going to be affected. Financial leverage is going to be affected, so on and so forth. Just be familiar with the major muscle movements and how they interact with each other. Okay. Learning objective number 3. Let's move on to explain consolidation. So we had fair value, which was an insignificant ownership stake. We had the equity method of accounting, which was 20 to 50% ownership. Now we're going to look at consolidation. Consolidation is over 50%. We now have control. We're calling the shots. And in that instance, the accounting treatment dictates that we completely consolidate the financials of the subsidiary business. And by completely consolidate, I mean we're going to take all the revenues of the subsidiary and we're going to add them to the parent company. We're going to take all the expenses of the subsidiary and we're going to add them to the parent company, excuse me. And by the time we do that, we're going to have consolidated income statements, we're going to have consolidated balance sheets, and we're going to have a consolidated net line item. So I'll show you how that all comes together. Pardon me, the allergies are getting the best of me tonight. Okay. And the first 3 or 4 slides leading into this accounting treatment are primarily a review here, so you see me skipping over them pretty fast. Importantly, when we consolidate and add the liabilities and the sales and expenses together, we need to note that we're eliminating any intercompany sales. Otherwise, we might be double counting, and we don't want that. Okay, let's look at an example. Assume the Penman Company acquires 100% of the common stock of Nissan Company. Purchase price is $3,000. During the next year, NISM earns $400, bringing its retained earnings to $1,400. On its own balance sheet, Penman accounts for the investment in NISM using the equity method. GAAP requires consolidation when Penman reports financial statements. Here's what that looks like. So we have Penman and NISM. We have the investment in NISM that shows up on Penman's balance sheet. We got to get rid of that, because when we show this in a consolidated view, well, we just want the companies both together as one. We don't want one company showing an investment in another company. So we just eliminate that. And then we can go line item by line item, and you can see most of these are just added together. If you don't see an adjustment in this column right here, then you're just adding Penman and NISM together. And that holds for most assets and most liabilities. But let's look at the exceptions. We have another exception down here in contributed capital. Well, we want the contributed capital of the parent company, so we can get rid of the contributive capital in the subsidiary, because we've already taken part of the contributive capital of the parent and made an investment in the subsidiary. So when we remove the investment from the consolidated reporting over here in the final column, we can also remove the contributed capital portion that is unique to the subsidiary. Same way with retained earnings. Now we have we have consolidated all of the assets and all of the liabilities. So as we do that, those will naturally flow through to the total equities and liabilities of the consolidated entity, and we can get rid of that number. And then lastly, same for the income statement. We're going to get rid of the equity from the investment. Okay. Let's talk about non-controlling shareholders and non-controlling interest. Note that only 80% of NISM's equity is apportioned to Penman shareholders. So there's still 20% of NISM's equity that is owned by somebody else. So how's that work? We're consolidating the financials as if we owned 100% of it, but we don't own 100% of it. There's still 20% of it that's owned by somebody else. Then maybe in another instance it's 5, or maybe in another instance it's 10, or maybe 20. Well, we need to account for that somehow. And you know, on a lot of your balance sheets, on a lot of your income statements, you're going to see a line item that says non-controlling interest. That is the line item that pertains to consolidated entities that we don't own 100% of. So that's exactly what we're talking about here. And we're going to put another account on our financials called non-controlling interests that serves as a contra account and represents those shareholders that own a smaller stake in NISM in this case. And that shows up as a $680 entry on the balance sheet, and the non-controlling or 20% stake, I think it was a 20% stake in the income, would be $320. Okay, we talked about investments purchased above book value. No reason to talk about that again here. Here our authors give us an example of goodwill presented on the balance sheet. So take a look at slide 46. And this is a fairly common disclosure describing a merger between Kraft and Heinz. This was in 2018. We actually owned some Kraft at the time. Turned out to be a pretty good investment for us. But you can see in the disclosures, I think this was in their 10K filing, you can see how they allocated goodwill and assessed the impairment of that over time. So when we put goodwill on our books, every once in a while we have to go back and ask ourselves the question, is that goodwill still real? Is that business still worth what we paid for it in 2018? Sometimes the answer to that question is no. When the answer to that question is no, we have to do a fair value market assessment with some rationale as to why that business has decreased in value. And periodically you'll see businesses do this, and you'll see a goodwill write down. So if you have $1 million in goodwill on your books, the business decreases in value. Maybe now that goodwill is only valued at 500,000. Well, your business is going to have to take a $500,000 loss, and that happens from time to time. And you'll see a disclosure similar to the one that you're looking at here for Kraft Heinz. Okay, I'm going to skip the accounting for intangibles and move into the consolidation of foreign subsidiaries. This is another one of those items that shows up in accumulated other comprehensive income. So, and this will affect a lot of you in class. We have a lot of companies that we're doing work on this semester that are global in nature. So when you do business globally, let's just take Apple as an example. Apple sells phones in Europe and they collect euros. Apple sells phones in China and they collect yuan or renminbi. Apple sells phones in Australia and they collect the Australian dollar. Apple sells phones in Canada and they collect the Canadian dollar. Well, typically the way that these companies are organized is that they have foreign subsidiaries to do business in each of these countries. And at the end of the year, they have to take the assets and liabilities that are unique to each of these foreign subsidiaries, and they have to translate those figures. They have to translate those assets and liabilities, which are recorded and denominated in euros or another foreign currency, and they have to translate that back all into the US dollar to make sense of the financial statements. Well, as we do that, there's going to be a cumulative translation adjustment. And FASB says that it's appropriate to put those in other comprehensive income because they can have big swings on the financials if we don't. So let's look at an example of how you might see that reported. So let's assume a European subsidiary has no changes in its balance sheet during the year, and they have a net income, or they see that the euro drops from $1.25 to $1.10. Well, if that happens, you're going to see assets and liabilities go from 1,500 in euros to 1,875 in dollars. Now the next year, you have similar assets and liabilities, only you have 1,500 in euros and 1,800 in dollars. There's the exchange rate. That's going to result in a translation adjustment of about, I think it's 225 here. And you would see that reported in the back of the 10K filing. You're always going to see an accumulated other comprehensive income statement reported in the 10K filing. So be aware of that. Okay. Okay, I'm skipping through some of these background slides so I can make sure I get all this material covered tonight. Okay, describe and interpret derivative disclosures. I mentioned that there were 3 bits of accounting that were going to show up in the accumulated other comprehensive income section. This is the third. When we're looking at derivatives, we're going to classify derivatives as either hedging or cash flow. So derivatives are typically used to hedge risk. We may have interest rates, commodity prices, foreign exchange rates, marketable security prices. If we have exposures to any of these risks, and we as a management team decide that, well, it's just too much risk and we don't want it, we can engage in a derivative contract, so a futures contract that hedges all of our exposure. So if we're, I don't know, if we're cattle feeders and we own a bunch of corn and we don't want the price of corn to go down, we can enter into a futures contract that'll get us paid if the price of corn goes down. Now we don't have that risk anymore. What I just described is a certain type of hedge that that we call a fair value hedge. And a fair value hedge, if it's executed right, is perfect insulation, meaning if you own a bunch of copper and you enter into a fair value hedge, if the price of the copper goes down, then the hedge mirrors that in lockstep. So there's really no gain or loss. There's no net effect on the balance sheet. And because of the way these fair value hedges typically work, the accounting treatment for those allow the changes in the value to go through the income statement. Now, contrast that to the hedging for what we call future cash flows, which are a little bit different. Now, in this instance, say we're contracted for, a certain number of widgets, and we know that those widgets are going to take this much copper or another commodity, and we want to make sure that those prices are constant over the next 3 to 5 years. We can enter into a series of hedges that make sure those prices are constant over that period of time. But because those cash flows take place in periods beyond time 0, FASB says that we want to put the net gain and loss from those in the accumulated other comprehensive income section. And I thought there was an example here, but the authors are really just wanting us to be aware of what the differences were there. So let's move on to equity carve-outs and their financial statement impacts. What's a carve-out? Well, a carve-out is a broad term that we use to apply to any transaction that takes a business or a part of a business that we own and gets rid of it. Maybe we sell it, maybe we spin it off, maybe we split it off. There's lots of different ways that we can separate one business from another. Those are called equity carve-outs. So just think of, carving out one business from another. And there's lots of reasons that we might do this. There are regulatory reasons. Maybe we want to raise cash. Maybe there's some strategic advantage. Again, you can find all of those in the equity filings of the companies that you're looking at. Couple different kinds are sell-offs. Say the parent sells shares of the subsidiary to an unrelated party. An IPO, I suspect all of you are familiar with initial public offerings where we sell shares to the public. Those are 2 different ways that you could carve out an equity investment. A third one is a spin-off. This is another one of the most common ways to carve out an equity investment. Spin-offs, by the way, are one of the most profitable areas to invest in the stock market. If you ever see a spin-off, take a look at what's going on, because you might be able to turn a quick profit, and that's just due to some uneconomic selling pressure that typically accompanies spin-offs. And I've seen this happen a lot when I used to work in the mutual fund industry. Say you manage a large cap fund, so you invest in the Boeings and the Coca-Colas and the Krafts and the Heinz and the Microsofts of the world. Well, if you get some company like Kraft spinning off, they spun off a company called Mondelez years ago. And if the dynamics of the spinoff are right, and the spinoff is a small entity, say you got a parent company that's $100 billion entity, and they're spinning off a much smaller unit that's a $5 billion entity. Well, if you're the mutual fund manager, one day you log into your computer screen and you see shares of Kraft. The next day you log into your computer screen and you see shares of Kraft, but you also see shares of a little spinoff company. Well, you don't want to own that spinoff. As a matter of fact, most mutual funds, they don't even have the charter to own that spinoff, meaning most of their clients have hired them to run large cap opportunities. So when they end up with this little small cap opportunity, what are they going to do? Well, they're going to sell it. And that's very common with spinoffs. You see a lot of immediate forced selling pressure, and that drives the price of the stock down. Well, it doesn't have anything to do with their earnings or cash flows. In the long run, the value of that stock is going to be determined by its earnings and cash flows. So when you see selling pressure that's uneconomic like that, it results in a buying opportunity. And if you go back and you look at spinoffs over time, that's the reason why they have historically been one of the most profitable segments of the market to invest in. So now you know. Split offs is another carve out where a parent company will repurchase its own shares using shares of the subsidiary company. The difference between a spin-off and a split off is that a split off requires the permission of the shareholders. They have the choice of whether or not to accept that transaction. The accounting for these is pretty simple. Usually you have a pretty simple exchange of shares or cash for the units of the underlying subsidiary. And then our authors take us through one example of these after the next. They just give us one example of an IPO, a spin-off, a sell-off. And I'm not going to hit on them here in class tonight. But that's good. So I left myself with a little bit of time. I covered that lecture faster than I expected to. Let me just stop there since we have a little extra time tonight. I'll take questions, or I'll go back and hit on anything that might not have been clear in the lecture. How would you like to spend the last 15 minutes?
I have a question.
Yeah, please.
I don't know if you covered it or if there's a video on the YouTube. I've been trying to find one.
Mm-hmm.
Been trying to load the SMF add-in for the project, and I just cannot get it to work.
Oh, it doesn't work. It broke. I covered that in class. There's an announcement on the Canvas page. I apologize if you've spent too much time working with that, but that's freeware, and it's not. And I don't support it. It's not supported by this class, but it has worked in the past, and other students have gotten that to work. So my advice is that if it's not working for you, use Morningstar. If you're one of the lucky ones that have gotten that to work, good for you. It's really a pretty neat utility when it works, but like I said, it's free and you get what you pay for.
So we would just pull our information from Morningstar and kind of manually fill it in?
Yes.
Okay.
That's exactly it. Yeah.
Okay.
Yeah, thanks for asking the question. Okay, crew, I am going to call it then for tonight. I'll have this lecture posted on our YouTube channel, and you can find it out there as usual. And hit me up with any questions between now and next week. I will lecture again next week, and we'll be back on schedule. So have a good night, all.
Next week is spring break.
Oh, is it? Okay. I hadn't looked at the syllabus yet. So I'll see you in 2 weeks. Thanks for
All
that.
right.
Thank you. Professor, I have a question. You said that if we turn our project in like 2 weeks early, you will review it and give us some suggestion. Is that correct? 2 weeks,
It would need to be close to 3 weeks early.
3 weeks
Yeah.
early. So the deadline is May 12th. Is that
Yeah,
correct?
but you need to get
And
that,
then
you need to get that to me by the 3rd week in April.
third week of April. Okay.
Yeah,
Got it.
good question. All right. take
Thanks.
care.